Welcome to Financial Snickens, your bite-sized information for entrepreneurs. Welcome to another episode of Financial Snickens. I'm your host, Lisa McCabe, and today we are continuing our series on reporting for entrepreneurs. Today we're going to be talking about setting and tracking key financial metrics. Understanding and tracking key financial metrics is paramount to making informed decisions and steering your business towards success. So, we're going to talk about what are these key performance indicators or KPIs, and that you should regularly monitor them to assess the financial health and performance of your business. So, first of all, let's talk about why. Why should you do this? Why should you be tracking these numbers? Well, financial metrics provide you a roadmap for strategic decision making. So, by understanding and tracking these specific KPIs, you can gain insights and be empowered to make informed choices regarding resource allocations, growth strategies, and operational efficiency. It can help you put your people, money, and power all in the right places. Another reason to do these KPIs and to monitor this on a regular basis is so that you can identify potential challenges early on, whether it's declining profitability, slow rising revenues, cash flow issues, expenses that are on the increase. And this early detection allows for proactive adjustments. So it allows you to take preemptive steps so that it doesn't get out of hand. So now you know why. So, what do you measure? One of the easiest things to do is to measure growth. Calculate the percentage increase of revenue over a specific period. We typically do month over month, but we also compare year over year. This way we know how much sales are growing each month and how much they are growing year over year. And consistent growth in revenue is a positive indicator of your business's health. Another number you want to measure is your gross profit margin, if it makes sense. We do not measure our gross profit margin for the way that we have our calculations and our KPIs. It's just one we don't use. It's not to say that you wouldn't. So for a gross profit margin, you evaluate the percentage of revenue retained after deducting the cost of goods sold. And a healthy gross profit margin is a good indicator that you're going to have profitability. The next one that you want to look at is a report called Profit and Loss by Percent of Income. It is phenomenal, and it really will help you to know where all your income is being spent. In QuickBooks Online, there's actually a report that's already set up called Profit and Loss by Income. You set it by periods if you want to do it quarterly or monthly, and it allows you to see where your money's being spent. What percentage of the income coming in is going to payroll, is going to rent, is going to insurance. And that way, when you track that over time, you can see where your money's being spent. You can also see when there are differences. Is payroll becoming a large portion of those expenses? So then we need to look into, why is that happening? Is it because revenue is decreasing, or is it because you're overstaffed? Something to look at and to review. Another KPI is a cash flow forecast. It helps create projections to anticipate cash flow fluctuations. This is crucial for ongoing operations and for planning on future investments. Accounts receivable turnover. This measures the efficiency of your collection policies. A high turnover indicates effective management of your accounts receivable. That means you're getting paid faster, which is great because that means you will have more cash. If you don't have good turnover in this area, if you're not collecting quickly on your accounts receivable, when you invoice your clients, if they don't pay quickly, you are going to end up with cash flow issues. And looking at this number will help to predict when you are going to have cash flow issues. Another one that I love is to calculate the cost of acquiring a new customer. Monitoring this number ensures that the efforts that you're making align with the revenue generation. So, how much does it cost you to acquire a client? This includes all your marketing, your salespeople. You have to figure out all the numbers that will go into this KPI. And then you're going to track it over time to see if it is increasing, decreasing, and make adjustments appropriately. The next one that I really like to measure is called the lifetime value of a customer. It determines the total revenue a customer is expected to generate over their lifetime relationship with your business. This helps in customer retention strategies. How much revenue can you expect when you land a client? What are you expected to get from that client over their lifetime? How long do clients stay with you? 2 years, 5 years, 10 years, 3 months? It will help you to see how long clients stay with you and what their value is going to be. The last one that I actually really like, and I've done lots of times, and you can do it on your own, it's called a Net Promoter Score. So it measures customer satisfaction and loyalty. A high NPS indicates a strong customer base that is likely to promote your business. So a high Net Promoter Score, NPS, is typically an 8, 9, or a 10. And you can easily do this yourself with a Google form, or you can utilize, there's so many companies that do this too, or their software. I think you can do it through MailChimp or Constant Contact. I think there's a lot of systems out there that will do it for you. And it's a great score to track, and it lets you know what's going on with your clients. And clients are more inclined to answer this type of survey because it's really quick and simple. The next thing you got to do is utilize the software to track all this stuff. So invest in a software that will automate this process. Many tools out there will provide real time updates and customizable dashboards for easy monitoring. But I want to stress keep it simple. If tracking your financial metrics is time consuming or cumbersome, you won't do it. Trust me. If something is too hard to do, you're not going to do it. We use a company called Tally Street as our dashboard software. It connects directly with QuickBooks Online and it provides easy to read information. And I love it because they have graphs, they have explanations, they have a lot of really, really good information, and it's easy to use. Also, you need to regularly review your financial statements. Conduct reviews of your income statement, otherwise known as your profit and loss, your balance sheet, and your cash flow to track changes and identify these trends. And then what you want to do is establish clear reporting periods, set specific times, either weekly, monthly, or quarterly, for tracking your financial metrics. So, and it might be different. So you might have one of these revenue, for example, depending on how often you are doing sales. Our company does sales once a month. We do automatic billing monthly. So we track our revenue monthly. Now, if we thought something was better done quarterly, there might be fluctuations, but we felt like it evened out over a quarter, then we would track that KPI quarterly. You have to decide what makes sense in your company and how to track that. So, setting and tracking these key financial metrics is a proactive approach to navigating the complexities of ownership of your business. And by regularly monitoring these KPIs, you're going to have a comprehensive understanding of your business health and performance. And it's going to help you make strategic decisions that drive your long term success. Remember, these aren't just numbers, they're a compass that can help you guide your business toward a sustainable growth and prosperity. If you want to talk more about KPIs or talk to me more about what my favorite ones are, you can head over to our website, firststepsfinancial.com, and you can also check out our blog. It has lots of information there, or you can click on Let's Chat and we'll have a conversation. Looking forward to seeing you.